mentioned earlier, I spoke with Larry Kantor, who's Barclays head of research, of what he makes of this most recent bullishness in the market.
Yeah, I think two things. I think the slowdown that we saw in the economy the previous few months really had everybody very concerned about a double dip. And as I said before, some of the news that we're getting in the U.S. economy suggests that we're not going into a new recession. That's definitely helped. The other thing is that in the last FOMC meeting, the Federal Reserve said that instead of letting maturing and prepaying mortgage securities, just cause their balance sheet to shrink, that they were going to reinvest those in Treasury securities. And this has now led to speculation that the Fed is going to restart its program of buying fixed income assets and even driving interest rates lower. So I think those two things have really made a difference to the markets.
Oh, so you think the markets are pricing in more QE coming from the Fed this week then? Is that a mistake? Are they being too over-optimistic right now?
I think they probably are. I don't think that most are expecting them to do it this week, but I think everybody's going to be watching the language of the statement very carefully to assess prospects for more QE. I think what's going to happen is the Fed is not going to do anything now, especially as some of the numbers have come in a little better in the last few weeks, but certainly leave open the prospect for doing it should the economy continue to be very sluggish.
Yeah, and what about the corporate, Larry? You know, we had Lennar, the home builder, coming out and beating forecasts. And then last week, a lot of optimistic numbers coming from RIM, Oracle. The corporate doesn't seem to be in pretty bad shape, does it?
No, it doesn't. You know, it's funny because that's been the case. I mean, corporate profits have actually looked quite good. Obviously, not every single sector. But in general, U.S. corporate profits have held up quite well. And as you know, in the second quarter, when we got the earnings numbers in July, they looked quite good, and the market still did pretty poorly. You know, it's worth noting that the credit markets have actually rallied a lot more than the U.S. equity markets. And I think that does have to do with the sluggish economy and the prospects for quantitative easing. And what we might see here, if the economy continues to look better and it looks less likely that the Fed is going to buy more assets, maybe what you see is equities start to doing better relative to credit.
Okay, but Larry, you're still advising investors to be a little bit defensive. You said that at this time we'd like to focus a little bit more on the defensive sectors like utilities and healthcare and telecom and consumer staples. When do you think you might want to get more into the cyclical plays such as technology, etc.?
Right. Well, first of all, we want to see a little better economic news before then. You know, you got to be a little careful because things like consumer discretionary usually do well very early in the cycle. We're certainly not early at this point. You know, it's very typical to get a pause in the recovery somewhere 4 to 6 quarters into it, which is where we are now. And we think the next phase probably will be, and this is contrary to most other people, a bit of a reacceleration. We don't think that the second quarter, where GDP was only a little better than 1.5%, reflects the future. We think that's actually an aberration, and you're likely to get 2.5% to 3% growth in the second half. And in that kind of environment, especially with the Fed keeping rates very low, that's pretty constructive for the financial markets and certainly for equities.
Now, Larry has gotten a few market calls correct, including the market bottom back in March 2009.